Welcome to Hedge Interview. I'm Jennifer Bruno, and this episode is part of the Manager Profile series, which features distinguished asset managers with a unique approach in their strategy space. My guest today is Andrew Cohen. He is a co founder of Difesa Capital, and he is the firm's chief investment officer. Prior to founding Difesa, Andrew co founded the Ramius Event Driven and Arbitrage Group within Callan Investment Management. He has 23 years of investment experience focusing on special situations, event driven, arbitrage, private equity, and distressed debt strategies. Thank you for joining me today, Andrew.
Great. Thanks for having me, Jennifer. It's good to be here.
So tell us about Defesa.
So, you mentioned I've worked across a lot of different strategies. And when I was thinking about starting something new, I really wanted to focus on something that had limited downside but optionality to the upside. And so, Defesa's main strategy is really focused on special situations where we're looking to capture yield for our investors that has limited beta to the overall market while also capturing equity convexity to the upside. We want to have limited beta to the equity markets and limited volatility to provide something that's a bit more stable, but where on occasion, when we get things right, equity-like returns can shine through the portfolio.
Okay, and so tell me a bit about your background and how you got into this space.
Sure. So I've been in the business, as you said, I've been in the hedge fund business for 23 years. And was fortunate to work at a large multi-strategy hedge fund called Ramius for the majority of that time. And while I was there, really worked across every corporate finance-based hedge fund strategy you can think of, whether it was long short equity or activist investing in deep value small cap equities or convertible bonds or warrant arbitrage or merger arbitrage or distressed debt. I think something unique that I bring to the table is that I have a breadth of knowledge about how to use different securities and different products across the spectrum. Whereas I think a lot of people today are really focused on one particular vertical. My background really spans multiple verticals, which really enables us to do some interesting things at Defesa.
And so that really dovetails right into your specific approach and your strategy. So tell us about how your strategy works. What are you how are you achieving your goals within this strategy? Tell us how it works.
Sure. So, we're looking to generate returns that sort of bridge fixed income to equity-like returns, and we're looking to protect downside. The name Difesa itself is defense in Italian, so we're always thinking about how to protect the downside while capturing a yield for our investors across the portfolio and that equity optionality to the upside. And we do that sort of through a three-legged stool. We will use multiple different asset classes. One asset class that I'm sure many people have read about over the past couple years that has had a boom and bust is the SPAC asset class,
Mhm.
where we've been able to extract a lot of value and have developed, a strong track record and really weren't dragged down in that boom and bust. Another one is the convertible bond market, where typically when you have bear markets like we lived through in 2022, you can see significant corrections and tremendous opportunity, which is a cyclical thing that I've seen happen multiple times in my career. And so we can use the bond portion of the convertible bond to capture that yield, or we can look to capture optionality through the call option that's embedded in the convert. And then we can use equities and we can use other equity linked securities like warrants or listed options to express our views. So whether it's in SPAC securities or in convertible bonds or in equities and warrants, we can utilize all these different tools to express views and create trades that we believe have limited downside and will generate a return, but often have this optionality to the upside.
And I mean, your strategy seems unique to me. I haven't come across many doing what you're doing, but if you do have peers in this particular space, how would you differentiate? What would you say is your direct point of differentiation?
So I think we're differentiated in that there aren't very many funds that are just focused on what we're doing. I think all the things that we're doing you would find inside of a large multi-strategy firm. And there would be a convert guy who maybe did some SPAC stuff, or there might be a guy who just did warrant arbitrage or warrant vol trading, or there might be a guy that just did value equities. Um, and so I think our differentiation and where there aren't very many peers for us is that we're doing all of these things in one unique format together, and it allows us to have an evergreen strategy across the cycle, where in a time when there may be less to do in the SPAC market, there's more to do in the convertible bond market, or if there's less to do in the convertible bond market, there might be more to do in orphaned equities or small cap equities. And I think our ability, my partner Greg Davis and I, our ability to look across asset classes, whether it's debt, whether it's equity, or whether it's a derivative, is really, a differentiator for us in how we can take this lens of looking for asymmetric risk reward trades and apply it, whether it's to one asset class or another. We're really coming at everything from a process perspective the same way, using our skill sets that are supported by 20 plus year careers in the industry across these different types of investing.
And what would you say drives your decision making across these asset classes? What is a driver that would make you focus on one sleeve versus another?
So I think first, I'll come back to that question, but I think, in thinking about our decision making in particular over the past year or so, we always have to think about the macro and what's going on more broadly. And that, will influence how we size the portfolio, how we utilize leverage in the portfolio, and how much equity exposure we might want to have in things like equities or warrants versus how much exposure we might want to have in something like bonds or SPAC cash yielding securities that are more safe, right? And so, certainly thinking about the macro environment influences our decision making at the portfolio level. And then, at the individual position level, really what influences us at the end of the day is the risk reward of a trade. And we're looking for things at a minimum where maybe if we lose, it's one down, and if we win, it's three up, right? And that 3-to-1 risk reward is sort of the bar that we're looking to achieve in any type of trade. And as I said before, then we can be kind of agnostic between these different sub asset classes, and have pieces of the portfolio in each of them at any given time. Um, and depending on what the macro environment is, we might want to lean one way or another. In 2022, we had a lot more exposure to SPAC cash yielding securities because they're very low beta and they're very safe. And there was a lot of volatility, and the market was contending with, the changes in an interest rate cycle and a revaluation of the equity market. And we felt that that was a safe place to generate a return for our investors. Whereas coming into this year, you know, we we view it as sort of we're coming to the end of that interest rate cycle. Inflation is starting to come under control a bit, maybe not altogether, but a bit. And so we're allowing ourselves to have a little bit more equity exposure and and certainly more convertible bond exposure.
It's great that you have that flexibility to kind of move where you need to move, where it makes most sense.
Yeah, it makes it so that we're not pigeonholed into any one thing. And as the market changes, we can change.
Right.
I listened to a podcast actually recently with uh, the pilot Sully, who landed the plane in the Hudson River,
Right.
and he was being interviewed as they were dedicating the Aerospace Museum in North Carolina, where he's from, to him and the crew of that. And as he was being interviewed, they were asking him, like, what are the sort of reflections you have on life and after this experience? And he said, you always have to be able to change course, and having these different tools that we have enables us to change course when the opportunity presents itself.
And it can be so critical.
Yeah.
So that's really good. And tell me about your team and how you guys work together. How long have you known each other and how you work together?
Yeah, so my partner Greg, he's is really my peer. We are very collaborative. We like to look at all our ideas together. At the end of the day, I get the final say, but it's a very collaborative approach, and I think we're very fortunate in that our trader Gambrell Snyder, she's been in the business for over 20 years, and our head of operations, our COO, Evan Focius. He's been in the business for over 20 years, and we've all worked together before. We all worked together at Ramius at various points. And so there's a lot of continuity in the group. And Gambrel can really deal with the trading and deal with our counterparties. And Evan can really manage all of our outsourced service providers, our back office, and our middle office, and allow Greg and I to focus on the portfolio and managing risk. And that's, for an emerging fund, a great luxury to have. And it's a great team that we have put together, and great that we have a long history together.
That long history is so key. It really helps a group have cohesion and efficiency when you just know how to work together over a period of time. That's really great. What is your approach to risk management?
So when it comes to risk management, we think about it in two ways. You have to think about it at the portfolio level and at the individual position level. And at the portfolio level, for us, the keys are really managing our leverage and our duration in the portfolio. And we're constantly measuring that and managing that depending on where we are in the cycle and what the opportunity set is that we're presented with. And with the volatility last year, we took leverage up as an opportunity to buy very high yielding SPAC securities. And now, as we are allowing ourselves to have some more equity exposure, we're bringing our leverage down because we're not it's not necessary to utilize it as much, given the upside and the convexity that we think we're creating in the portfolio, and all of the warrant exposure that we have built up over the past several years. At the single position level, every position starts with downside risk assessment, right? Before we're really thinking about how much money can we make in this trade, we're first thinking about how much money could we lose in this trade. And that comes from both Greg and my background in merger arbitrage, where if a trade goes against you, you could be down 30 or 40%. And so every trade has a downside level associated with it, whether it's a downside price in a stock or a yield in a blowout yield scenario for a bond, or a SPAC piece of paper. And how much are we willing to lose? We generally don't want to lose more than 1% or 0.5% in any one position if it goes the wrong way. But like I said, we're looking for 3-to-1 risk rewards. So if we're setting up trades where we could lose 0.5%, right, then we could be making 1.5% on the upside, maybe more, and that helps to keep things very tight. So measuring and managing single name risk as well as portfolio level risk are important to us.
Great. That's super important, as you know, to investors and you guys have a really comprehensive approach where you're really focusing on it. So that's really important. And what would you say is an important lesson learned or lessons learned in your time so far with Difesa that you're bringing with you into 2023?
I don't know about necessarily just the FESA, but in my career, I would say, um, the one thing is that the market can remain irrational longer than you think. And so, you always have to be prepared for that in assessing your risk, as things don't always play out on your timeline. I would also say that something I learned from my past partner is that edge is ephemeral, and that if you have edge in a trade, if you have a piece of research, or you have a trade that sets up in a particular way, it may not be there for that long, and you have to take advantage of it and size up into those situations when you really have the opportunity. And lastly, and in particular, as it relates to the way this year has started out with the markets really tearing to start the year, it's never good to chase the market. And nothing good ever comes of that. And, you may underperform for a time, but when you chase, you end up, getting yourself in trouble. And that's not a good thing to do.
Right,
So
right.
you have to stick to your knitting.
Yep. And what are you focused on right now? What has your attention, maybe in the global macro sense?
So we're certainly focused on interest rates that are continuing to rise and how that's going to affect valuations in the equity market, and constrain the supply of money and the availability of liquidity. But from a micro point of view, or from a portfolio point of view, there are so many companies that have come public between 2019 and 2021, and even some in the beginning of 22, that are really orphaned and have been forgotten about it. The old adage of the baby being thrown out with the bathwater. So we're focused a lot on small cap companies where we see asymmetric risk reward opportunities. And in the convertible bond market, the convertible bonds in 2022 were faced with two headwinds. Not only were they being repriced because interest rates were repricing the bond portion of the security, but the equity portion of the security was being repriced as equities were selling off. And so that was sort of a perfect storm for that asset class. And according to Bank of America, it was the worst year for convertible bonds since the financial crisis in 2008. And by mid-December of last year, over two-thirds of the convertible bond market was trading below par. And
Mhm,
so we see a big opportunity there in what we call busted converts that are out of the money, where we can really add value through our credit underwriting and our equity underwriting to find hidden yield and hidden optionality.
mhm. That's exciting. It'll be interesting to keep an eye on you guys and see how those developments play out. So
Yeah, absolutely.
it's exciting. Well, thank you so much for joining me today. This was a great interview, and it's great to learn about Difesa.
Great. I appreciate you having me, and we look forward to staying in touch.
So for more information for everybody who wants to look a little bit more on Difesa Capital, you can visit their website at difesa.com.